of January 1st, 2023, fell to $35.53 billion as of the end of March 30th, 2023. At the last Monetary Policy Committee meeting in Abuja in March, the governor attributed the decline in the external reserves to the fall in crude oil prices. And Nigeria has again called on the United Nations and international tax community to forge an inclusive, equitable and fair, universally beneficial international tax system towards the attainment of the 2030 Sustainable Development Goals. Making the call on behalf of Nigeria's Mr. Mohammed Nami, the executive chairman of the Federal Inland Revenue Service, while delivering Nigeria's statement at the Economic and Social Council special meeting on international cooperation in tax matters. Mr. Nami noted that the Nigerian delegation is concerned about the global minimum tax as put forward by the OECD inclusive framework because of its low rate and the way it was negotiated to benefit home countries of multinationals. Speaking further, the head of Nigeria's Apex Tax Authority urged the meeting to discuss how on tax cooperation can both build on work that has already been done in a way that guarantees fairness and equity. Now, moving on to the global oil market, we see oil prices have surged after Saudi Arabia and other OPEC Plus producers announced a surprise round of output cuts. For analysis now, let's talk to Sunil Dixit, Chief Technical Strategist, SK Charting, join us via Zoom. Great to have you on the show.
Thank you.
So how do you see this surprise cut? It's a surprise to everyone. Well, I'm sure you were surprised too.
Well, this is a typical strategy often pursued by OPEC whenever they see prices falling somewhere in the vicinity of $60 or something. And they have a beautiful excuse of, they say like Saudis, they confirm we are trying to put stability, bring stability to prices. So their theme is that they don't like prices going down below $60 or below even in the neighborhood of $60. They want to sell more oil and they want to sell at higher price.
And we're already seeing that
very uncomfortable whenever prices are dropping below 66 or 68 something.
I already see the price reacting to that surprise hike this morning. But, looking at where we are now, how do you see this price rise that we saw today? Is it going to be sustainable throughout this week? Or do we see prices, coming right back down again once the dust settles?
As soon as the markets have opened, we have seen a sharp gap up. And this runaway gap will be filled eventually. The prices have gapped up above 75.70. And now, when we see the prices have already tested high of 81.58 and very close to 50-week exponential moving average that sits at 82.50. That is inches away from where we are. And prices are consolidating below the resistance, and a tendency is developing for filling the runaway gap. That's a technical thing. The gaps have to be filled up eventually, though this is not necessary that the entire gap is filled before the next up move. So prices can consolidate below the resistance and even before filling the complete gap, before the prices come to fill the gap at 75.70, somewhere in between, even around 78 or 77.50, prices can make a rebound and make some more gains to 82.50 and 83 areas. But the major resistance on the higher side would be 86.50. That will be the challenge for bulls.
All right, I guess we'll be watching how the bulls can, break that resistance. Thank you so much, Sunil Dixit, Chief Technical Strategist, SK Charting. Thank you.
Most welcome.
All right, so we'll be looking at those, drilling down those oil prices as the week progresses this week. But as the cash scarcity continues, experts have been preferring solutions to the failed online transactions Nigerians are currently experiencing. While some say the overcapacitization of the deposit money banks online system will solve the quagmire, others believe a holistic look at the nation's system will turn the light on at the end of the tunnel. Well, in this next report, our technology correspondent, Victor Matthias, takes a look at the technology powering online transactions, its workings, and what went wrong as Nigerians in their numbers reverted to mobile banking applications and agency banking to meet their financial needs. Take a listen.
Few months after the Central Bank of Nigeria announced the cash policy redesign, what used to be part and parcel of social and economic life among Nigerians, the Naira notes became a scarce commodity in a twinkle of an eye, with many besieging banks and ATM points to obtain cash. While many, especially the unbanked, were grappling with the reality that dawned on them as a result of the policy, other Nigerians were forced to resort to alternative banking means, which to a certain extent also failed to deliver the desired result. While some Nigerians have applauded the CBN's decision to move the economy in a cashless direction, they wonder why adequate infrastructure was not put in place first to make that transition seamless.
Sometimes might do transaction, the customer will be debited and no credit on the POS, and some customer will demand for their money, and we have to just call the customer care.
They are ripping people off, and most of them don't even want it to stop. They want Nigeria to just be like this, so that cash can be scarce, and people would always come around, you understand, to still keep buying money from them.
Dr. Yeleo Keremi, a financial expert with over 25 years' experience in the global economic system, explains the workings behind the technology that powers online banking platforms.
This is that there is something called a switch, which is basically a software contraption sitting somewhere that connects several banks together, which is like, so the switch sits like a hub, so to speak. At various bank ends as well, they also have their own infrastructure for both the outward and the inward messages or transactions happening across the switch. And then when those transactions are also either going outwards or coming inwards as well, the banks also have some work to do in the back end at their core banking application level.
His explanation seems quite straightforward, but what could have been responsible for the failed electronic transactions recorded during this period?
We can't say that this is exactly what the problem is, that once I can't do a transfer, it's a problem from my bank, or it's a problem from the recipient bank. No, there are three different entities involved here, but it's always very rare for the NIP system to go down because they are the one powering all transaction in Nigeria as we have it today.
Experts say a solution is on the horizon, but are the players willing to make the necessary investment?
Overcapacitization has costs. So if the banks attempted to overcapacitize in previous times, then the entire electronic banking system may not be profitable or sensible to them. So they needed to maintain the balance. I think what happened was that so much happened within such a short time that it caught everyone kind of napping.
It is hoped that with the circular from the CBN last week saying that enough cash has been evacuated to deposit money banks, which have also been mandated to work on Saturdays and Sundays, it remains to be seen whether the pressure on digital channels to carry out daily financial transactions will be without hitches. Victor Matthias, Channels Television News.
Welcome back now to our first conversation. We see the National Bureau of Statistics at the weekend revealed that in the fourth quarter of 2022, Nigeria's domestic and external debt profile hit 46.25 trillion. In terms of composition, the total domestic debt stock was at 27.55 trillion naira, while the total external debt stock stood at 18.70 trillion naira. Joining me now is Chinwe Grim, Chief Economist, Coronation Merchant Bank. To give me a perspective. Great to have you on the show. Good morning.
Good morning. Thanks for having me.
So, Joe, it's a 6.69 trillion increase from 39.56 trillion in December 2021. That's just about 1 year. What came to mind when you saw this report?
Ladi, the total debt stock as at the end of last year stood at about 46.2 trillion naira. And this year-on-year increase is in the total debt stock is not surprising, given that the FGN's projected budget deficit for 2022 was about 27% higher than what was set in 2021. Now, last year, there was visible reliance on domestic borrowing compared with external borrowing, and this was really on the back of Nigeria's absence from the international capital market, which has been partly due to the hawkish monetary policy stance adopted by select central banks across advanced economies. And of course, what did that do? That led to upticks in interest rates. The approximate ratio that we've seen, which is about 60-40 for domestic versus external borrowing, seen in recent release, reflects this trend that I've just expressed. Now, we did notice that there was underperformance in 2021 when we consider the target that the FGN has set in the budget of that year. I believe actual revenue for 2021 was about 78% of expected total revenue. And for 2022, revenue performance based on January to November, which is the latest data that we have, was relatively better, but can still be regarded as underperformance, as the actual revenue between this period, January to November, is about 87% of the expected 2022 total revenue set in the budget. And all of this matters when we're discussing borrowing or the debt stock. Let me also shed some extra light on domestic borrowing. The FGN's share of total domestic debt, based on the data released, accounted for about 48%, while states and the FCT collectively accounted for about 12%. It's worth noting that the DMO exceeded its borrowing target for 2022 by about 553 billion naira. And this was through its monthly bond auctions, right? In the secondary markets, the average yield for FGN bonds was at double digit at the end of December. It stood at about 13.04%. Also worth mentioning is that the DMO attributes the increase in the debt stock to one, new borrowings by the FGN and subnationals, primarily to fund budget deficits and execute on projects. And secondly, the issuance of promissory notes by the FGN to settle some liabilities also contributed to the growth in the debt stock that we've just seen.
All right, looking at the composition now, we see obviously domestic debt is, more, compared to foreign debt. But looking ahead, what is your view on, domestic debt and your thoughts on market rates?
Okay, well, considering the maturity profile of current FGN debt instruments, the first half of this year brings with it improved system liquidity. However, in H2, that is second half, we expect continuous tightness in the interbank market as the FGN front loads domestic borrowing due to its projected budget deficit that I mentioned earlier. And also our expectation of continuous low activity with regards to external borrowing. The expected demand and supply dynamics of FGN debt instruments in 2023 point towards upticks in yields in the domestic debt market. Now, over the next 3 months, we expect the average FGN bond yield to range between 13.7% to 14.9% at the middle of the curve, and slightly higher at 14 to 16.2% at the longer end of the curve.
And definitely, we've had that argument. We've seen experts talk about debt, not being a bad thing, in itself, but you should be able to pay your debt. That's one major issue there. But if you're generating enough revenue, as a country, then obviously, rising debt shouldn't be a problem. But what do you think can be done to increase, revenue generation, in the country?
That's a really good question. But let me try and give you a few answers off the top of my head. I would say the planned removal of the PMS subsidies should support increases in retained oil revenue, boosting security and efficiency across oil production value chain will also have a significant impact on revenue. Boosting non-oil revenue by broadening the tax base, plugging loopholes, and enhancing collection efficiency by deploying technology and automation would also help. I think boosting export receipts from agricultural products, minerals, and manufactured products, which require tackling logistics issues such as storage, packaging, and warehousing. I think something to note as well is that manufacturers continue to struggle with producing profitable standard products able to compete in the global village due to infrastructural issues. So these issues need to be tackled as well if we're working towards enhancing or boosting revenue.
And obviously, we've seen, analysts talk about how the new incoming government would also have to, keep borrowing to, fill some of these deficits. But what's your outlook for Nigeria's debt level going forward?
Okay. Well, an expansionary fiscal policy posture has been adopted in the current administration, and we do expect to see the same trend, at least in the medium term, with the incoming administration. Now, the ratio of capital to recurrent expenditure is expected to be higher over the next few years. So that ratio is actually 30 to 70. So we expect to see a slight shift with that ratio. An expected spike in capital expenditure will impact deficit financing gaps. So we expect the domestic market rates to trend up as continuous reliance on domestic borrowing versus external borrowing is likely to keep yields on the fixed income instruments elevated.
Q1 is over now, and obviously it was a challenging, some have described it as challenging quarter, and now Q2 is upon us. What are your expectations for Q1 GDP for 2023?
Well, for Q1, we expect GDP growth to moderate to a level within 2.3 to 3.3% from 3.5% that was recorded in the final quarter of last year. Now, some factors that are influencing this forecast include weak consumption patterns on the back of high inflation and its impact on service-oriented sectors, continuous transmission effect of FX depreciation on business activities, the impact of high borrowing costs on SMEs activities, and the cash scarcity effect. So the Naira scarcity effect that we've seen, which was triggered by the redesign policy, the Naira redesign policy. And also a lagged effect of the flooding crisis, which happened towards the end of last year. We actually do expect to see that impact the Q1 figures, at least for agricultural GDP output, which accounts for over 20% of the national output.
The headwinds experienced in Q1, do you see those headwinds staying with us in Q2? And what are you expecting for Q2?
Well, for Q2, we expect to see GDP growth still within the same range. I think upticks are feasible towards the end of the year, so towards the middle of Q3, Q4. And that is really on the back of how the transition effect takes place.
All right, we'll be looking out for all of that. Thank you so much, Chinwe Egwin, Chief Economist, Coronation Merchant Bank. Thank you for your perspective today. All right, so after the break, we'll be drilling down on our debt capital market as corporates debt issuance hit a new high. That was for 2022. That's our next conversation. Do stay with us. back, and we're still talking debt right here, and this time it's about corporate debt. See a record 1.5 trillion naira of local currency 22, representing a 133% increase from the 2021 level, and now more than ever, with the uncertainty surrounding access to capital needed to expand, business operations, companies have found solace in commercial papers. Well, let's talk to PoliticsToday Majako Dumina, Managing Director, GCR Ratings Nigeria. Join us right here in the studio. Great to have you.
Thank you very much for having me, Laddie.
Yeah, so quite a jump for 2022 for corporate issuances, compared to 2021. But before we, drill down on 2022, there was a slowdown.
Yes.
In 2021. What do you think drove that?
So yes, there was a slowdown in 2021. In fact, debt issuance, and when we're talking about debt issuance, we're talking about commercial paper and bonds, that came down around 38%. Now, really back then, in 2021, that was down to the fact that we saw interest rates rise from a fairly low base. So before 2021, late 2020, yields were very low. And then they started to increase quite quickly in 2021. If you are looking at Treasury bills specifically, the 364-day T-bill rates increased from about 5%, I think, in February 2021 to a peak of near to 15%. That increase actually meant that corporate Nigeria issued a lot less when it came to debt issuances, commercial paper and bonds.
Yes. And for 2022, then we saw that, big jump.
Exactly. So a significant jump. So in 2022, let me just frame things. We saw, like you said, 1.5 trillion naira of debt issuance. That's about $3.2 billion. And like I said, it's coming from commercial paper and bonds. So when we say bonds, anything over a year in maturity, commercial paper is less than a year. And about 50-50. So of that 1.5 trillion, about $250 billion was from commercial paper, and about $250 billion was from bonds. Now, from the commercial paper perspective, we actually saw 140 transactions, commercial paper transactions in 2022, and this is really just down to corporates in Nigeria managing their cash flow. When you have inconsistent cash flow or there's near-term uncertainty, because last year there was very high inflation, which we still see as of today, but spiraling fuel costs, there was supply-side disruptions. Corporate Nigeria just really needed that liquidity balance, if you like, to manage itself. So you saw a lot of corporates issuing commercial paper. Now, on the bond side, you saw big-ticket transactions. So I think if you look at the top 5 transactions, they probably made up a large chunk of, again, the $250 billion naira of bond issuance that we saw. So last year we saw big transactions that were really a part of capital expenditure projects and also some acquisitions. So let's take it from the biggest to the relatively smallest. Dangote Industries, whose parent company effectively of Dangote Sugar and the owner of the refinery, and Dangote Cement, of course, they issued 300 billion naira really as part of the financing of the refinery. Next in line was Dangote Cement, which issued, I think, 116 billion naira, and that was part of expanding some of its Nigerian projects or its Nigerian expansion projects here. Then you had MTN, slightly below, that's at 115 billion naira to expand its 5G network. Then in terms of the smaller but still large issuances, we saw Geregu Power. They issued around 40 billion naira as part of an acquisition or to fund an acquisition of a power plant. And then we saw Presco Nigeria, which is in the palm oil business, raised 30 billion naira to acquire as part of the acquisition of another entity in the palm oil business. And then lastly, Lagos Free Zone Company, they raised 25 billion naira of guaranteed debt, guaranteed by InfraCredit, I believe, and that was to develop some of their assets in the free zone area. So a lot of big ticket transactions, and that really was what was driving issuance in 2022.
Yeah, quite big. But looking at the composition, at this time, we're seeing corporates here, get more towards local currency debt at this time.
Yeah.
obviously we know what's happening with foreign, currency. But is there any risk, because there's still that issue of currency devaluation? How's that playing into it?
There is. So, like you mentioned, because of the foreign currency challenges in the economy, that kind of manifests itself in terms of foreign currency shortages and just weakened relationships between, say, Nigerian banks and correspondent banks, foreign correspondent banks. So if a Nigerian company does have access to hard currency in the form of US dollars, it tends to be very expensive. When I say expensive, in terms of the interest applied to those types of borrowing. And of late, it's just not really a viable form of funding for Nigerian corporates. So you've seen a lot of Nigerian corporates just raise their money locally in Naira and these capital markets. And local markets are more than capable of funding these businesses. Obviously, there's credit risk behind lending anywhere, regardless of whether you're in Nigeria. And that's what we do as a business. We analyze credit risk. We tell investors, we give investors information on the risk behind debt instruments and allow them to make an informed decision. But yes, there's always going to be that credit risk there behind these debt instruments.
And definitely a big jump, 133%. What is this level of issuance? What does it mean for the Nigerian economy?
Well, I mean, capital markets are always very beneficial for economies, and we've seen this all around the world. Allows the private sector to effectively grow. So capital markets fund growth. And if you're funding growth, you're obviously increasing aggregate demand within the economy. You're creating jobs. And from that, ultimately, you're supporting economic growth within the economy. Also, I think capital markets allow for a lot more efficient allocation of capital within an economy, more efficient than just banks providing bilateral loans between themselves and their clients. And also, lastly, I think it's very good for the diversity of risk within the economy. You end up with less pockets of risk in terms of those holding debt or those investors holding debt. Capital markets help the economy move that around. So when we see lots of issuance like we saw in 2022, it's generally a positive thing.
And obviously, when you have these issuances, there are buyers. And, markets, we have, institutional, buyers, and we have retail. But looking at these issuances, who are the buyers at this time?
So the buyers are, I think, two, or really you can call them three main buyers. You have the pension funds in Nigeria, you have your mutual funds and / asset managers. So in terms of pension funds in Nigeria have about 15 trillion assets under management, which I think is about, using official exchange rates of today, is about $33 billion. Now, of those 15 trillion of assets under management, they have about 1.4 trillion in corporate bonds. Now, just to give you the quantum, the size of corporate bonds outstanding, as of, I think, February end, there's about 2.1 trillion of corporate bonds outstanding. What's that? About $4.6 billion. Now, so I'm basically saying of those $2.1 trillion, 1.4 is held within pension funds or thereabouts. And I think the bulk of the rest is coming from your asset managers / mutual funds. So those are the key investors here in Nigeria.
And definitely where they're sellers, they're always
exactly,
buyers at this point. So what's the outlook for issuance in 2023?
Okay. So in this report we wrote last week, or we published last week, we think issuance this year is going to remain robust. And going forward, I believe we'll see continuous growth in issuance. Now, we have very good oversight of that as a rating agency, GCR. In Nigeria, we rate 80% of outstanding debt. So when I mentioned that 2.1 trillion, that $4.6 billion equivalent, we rate 80% of that. So we have very good sight of this stuff. So I think what we think is going to drive issuance this year is, firstly, we've seen a fall in yields. Yields have come back down, although in recent weeks there's been some moderation in that fall and they're ticking back up. But basically, at the end of last year, we saw the largest federation allocations or federation account allocations of the year in December, close to 1 trillion naira. We also saw, because of the Naira redesign policy, at the end of January this year, 2 months prior to that, we saw close to 2 trillion Naira come into the financial system. Now, all that liquidity needs somewhere to go, and that effectively crashed yields in money markets. So when we talk about money market yields, it's kind of a proxy for where corporate debt instrument yields would be. If money market yields are coming down, then it's likely to be cheaper for corporates to borrow. Now, because it's cheaper for corporates to borrow, we're likely to see more issuance in the near term. So that's what we're saying there. But generally speaking, I think bonds, commercial paper just allow for effectively a viable form of funding. If you look at how much or at what level banks are currently lending at, what rate they're lending at, if you use this data is all available within the CBN. The prime rate for lending within Nigeria's banks is around, I think, between 13 and 14%. In fact, some banks, their prime rate is as high as 28%. But when you look at what these corporates are achieving in capital markets, it's anywhere between 12 and 13%. So capital markets and debt issuance allows corporates to borrow at a cheaper rate. I think also, to answer your question deeper, given that we have the new leadership coming in, I think once we see what the political direction of new leadership will be, corporates in Nigeria will be able to make better informed decisions, and we'll actually see an uptick in issuance again, or probably over the second half of the year.
I'll be looking out for subscription also with that. Thank you so much.
No problem.
I was Akintunde Majakodumi, Managing Director, GCR Ratings. It was great having your perspective.
Thank you very much, Ladi.
Today.
Thank you.
All right, so we're talking debt market there. We have other markets coming up in just a little bit. We'll have John McQuarrie giving us the details of what happened and the markets, talk about the NGX and the fixed income market. That's in a moment. Do stay with us. All right, let's head on to the markets now. We have John McQuarrie with the details. Great to have you.
Good morning, Ladi.
Good morning. And obviously, it's been an interesting first quarter in 2023.
Yeah, very interesting. And our debts are hitting 46 trillion naira is another interesting factor.
Yeah.
Even though, as I said last week, that it had already been projected that it's going to hit 77 trillion by the end of May, so I guess we're just...
Because once you factor in ways and means.
Yeah, that ways and means is a bitter pill.
Yeah.
On our economy, but I mean, anyway, let's do the markets now and see how the FX market, Mondays are for FX market, see how that fared. Well, for the week ended and the month and the quarter ended March the 31st, we saw that weekly there was a total of $770.82 million, a daily average of 157. We saw that the week-on-week change for the FX spots was actually in the negative, about 0.5%, 42.14% change. But the forwards was more than 100% in the positive, while the FX derivatives was 62.01% in the negative. Looking at others now, the I&E window, we saw transactions there, a total value of 540.65, and that's less when you compare it to the week before. But I mean, let's get Bosmo Bembe now, FX dealer with Access Bank PLC, to help us understand what these numbers mean to our economy, to our pocket, and to our foreign exchange. Good morning, Bosmo. Thank you so much for your time this morning.
Thank you for having me.
So let's have a quick review, Bosmo, of the first quarter ended, the month of March ended on Friday, an unusual thing. But you have the details behind the numbers. Tell us, how did our FX trading do? And of course, this has affected our reserve. We saw that it dipped at the end of March, but how did we do generally?
On the FX, the investor and exporters window, which is the recognized window where we opened the year with 461.5 and closed the quarter with 461.3, which is a 12 kobo depreciation. In terms of the volume in the investor and exporters window, that was a decline. If you look at it quarter on quarter, it's about $252 million decline. In terms of intervention, CBN continues to be the major contributor and participant in the investor and exporters window. It sustained its intervention in the retail SMEs and the investable and SME space for the treatment of PTA and for PTA. However, in terms of reserve, like you said, we've seen a decline. And if you look at it quarter on quarter, we've declined by about 1.5 billion, which is about 4.2% decline from what we had in December. This can be attributed to the downward trend we've seen in crude oil. Between the same period, the oil price also declined by 5.7%. So that shows our external reserve moves directly with movement in the oil price. But fortunately for us, the oil cut by the recent announcement by the OPEC of oil cut, which has brought the oil price, is currently trading at $84 per barrel, which is the levels in December. So we may continue to see our reserve going back up maybe in the next few months.
So it doesn't look like diversification efforts, diversification of source of revenue, doesn't look like it's contributing, because it's either our oil, CBN intervention, or we don't have anywhere, when it comes to our reserve.
For now, if the major contributor to our external reserve has been the crude oil price and the investor coming in, foreign portfolio investors. And if you look at our yield, coupled with our inflation that is currently at 21.91%, so it's not something that will encourage any rational investors to actually come to a country now. So we're not seeing the accretion due to maybe the diversification or maybe due to the attraction in terms of yield. Our yield tool is actually not very attractive to bring in maybe foreign portfolio investors. But last week, the last auction on the NTB, 1 year NTB, closed at 14.74. So I believe if this is sustained, it may be a leeway to getting a more foreign investor to actually maybe take a look at our market. But for now, it's been the crude oil has been the major source.
And unfortunately, the remittances are not helping.
Yes, we've been getting things from remittances, but when you look at the demand and the supply, so the demand for FS is more than what we are getting from the remittances. So that's the reason why, even though we're getting remittances, is not enough to cater for the demand that we have currently.
All right, Bosun Obembe, FX dealer with Access Bank PLC. Thank you so much for your time this morning.
Thank you for having me.
All right. If we could just have a little bit of snippet of the equities market before Ladi takes over. Thank you so much. So, unfortunately, the equities market is back in the red. Month to date is down. This was for last week, 1.20% in the red. Equity cap, that's the market cap, and then the all share all in the red, even though we're still at 54,000 there. So maybe this week will be better, and we will get to 55 or recover, Ladi. Right. I believe you'll be giving us the stock market report later on today.
For the
so
first
we expect
one
good
in the second quarter, first trading day.
First trading day in the second quarter.
And quite impressive gains, for the first quarter. Talking about the NGX, get about 5%, for the whole quarter, which is quite impressive with the headwinds.
Yeah, but we still have the negative month to date.
Yeah, we have negative month to date, but what it gave investors in the first quarter is what I'm talking about now.
Oh, okay.
5%. which is not bad.
Yeah, investors took those money out. That's why we have this red here.
Yeah, that's why we have red for the week, though. But
a lot of profit
not
taking
bad.
Friday. I think on Friday was one of the magical trading days for me because
Yes.
we're in positive 0.82%, and just when the bell just went off, we were down.
And it just switched.
Exactly. It was
Quite incredible.
It was shocking.
Quite incredible. Thank you so much.
All right,
Amy,
thank you so
giving
much.
us the details there for these markets. Let's head on to the UK now. We have Juliana standing by right there. Great to have you, Juliana. So it looks like millions of the lowest paid workers across the UK will receive a pay increase. The UK government hailing an increase in the national minimum wage. Sounds like good news there.
It is good news. Good morning, Laddie, especially for people, as you know, who are suffering in the UK at the moment with double-digit inflation. There's been a slew of increases as well. As anyone has been looking at their bills, they would have seen that their phone bill has increased by a minimum of about 3.5%. Also this week, council tax payments, they increased by 5%. And then those kind of one-off or instalment payments that the government were giving to those on the lowest incomes in this country, you're not going to be getting them anymore. So this announcement that the national living wage has been raised by 9.7% is a good news story. So I believe if you are on the lowest pay in this country, you will see your pay packet go up to about 10.43 pence an hour, which of course is going to help people who are struggling at the moment in the wake of soaring bills and more soaring bills, because over the weekend, more bills were increased, as we would expect in April, as you were just talking with Innie, first trading day of the second quarter. April is a time for HMRC as well. So lots of self-employed people got to get their taxes all in a row to make sure that they don't get any extreme fines and add more woes to their already beleaguered bank accounts.
Yeah, quite incredible there, because, with rising inflation, the experts say you don't want to raise wages, so that you don't end up stoking inflation more. But at the end of the day, the workers have to eat at some point. But it's a new week.
We need to eat.
Yeah, exactly. So it's a new week. What market-moving data should we be expecting?
It is a new week, a short week, of course, because we've got Good Friday on Friday. So the banks and the markets are going to be closed. It's quite a quiet week. Parliament is in recess for the Easter holiday, so we're going to get very little out of number 10 Downing Street. I think this week really is going to be dominated by strikes. Just this morning, the National Education Union rejected overwhelmingly a pay offer from the British government. I believe they were offering all teachers in this country a £1,000, which is probably about £1 million naira at the moment, a one-off payment of £1 million naira, plus a 4.3% pay rise. Not good enough, say the union. So expect more strikes soon. Expect me to be at home with the children in the background anytime from now. And also as well, lots of people in this country we know love to get away for Easter, but there have been strikes on the French border. In fact, we've been hearing some horror stories of school children being trapped on coaches for over 12 hours trying to get themselves from Dover to Calais. And then we've got some other market moving data, such as new car registrations. I think we get that data on Wednesday. And then on Thursday, we'll also be looking at the average house price in the UK. So pretty quiet. But of course, in the business news, we'll just have to wait and see. There's always somebody saying something somewhere.
Exactly. Somebody saying something. So thank you so much, Juliana. I will see you at 1:30.
See you then.
All right, so let's see what's happening with other markets. As I did mention, the first quarter was quite challenging for most markets, but we see that Bitcoin managed to rise above some resistant levels there. We see greed still holding, right now, this market, 63 points over 100. I see that the investors are still quite bullish, at this point, even though we've had, a couple of bad news now strolling into the crypto market with the bank crashes and all of that. Market cap there sitting at 2.21% down, and volume traded, we're seeing that's up 13% from buy and sell pressure in the market at this time. Bitcoin dominance sitting at 46.24%. Eyes on that Bitcoin dominance might be inching up to 50 at some point. Let's look at the price of Bitcoin this morning, $27,741, about 8 a.m. this morning, down 2.45%. And we see volume traded, that's $13.49 billion for Bitcoin. Let's look at Ethereum now, $1,781, also down 2.11%, and volume traded $6.54 billion we'll see for Ethereum, and it's all red for the top alts by market cap with Matic there, the biggest down 2.23%. Let's bring in Michael Naji now, financial market analyst. Hello, Michael. Good morning.
Good morning, Ladi. How are you? Thank you.
Great to have you, Michael. So first quarter, it's been described as tough for the crypto market, but Bitcoin still leads the way by outperforming most assets in the first quarter. How are you seeing this?
Yeah, so it looks to be so far that we've had a very relieved. We've been relieved by the market, and we've had a rally. And so you've seen Bitcoin go all the way from 16,000 to about 30,000. And the bid behind that is the rationale that, in an environment where the banks fail, most Bitcoiners and most people in crypto, their faith in Bitcoin is, highly increased. So that's where that bid is coming from. It's coming from, people just believing more in all the aspects of Bitcoin that makes it resilient. Where do I think we're going for Q2? I think what's most likely is Bitcoin probably breaks like 40,000 or high 30s. The recession, the real meat of the recession probably is going to kick in sometime in Q2. So what I think is most likely is we make higher highs, 30 to 40,000. But eventually, at some time this year, you can expect Bitcoin to retrace maybe another 40%. So if Bitcoin was to go to 40,000 and retrace another 50%, from that, it would only be at 20,000, which is where we are at right now. So it's my belief that yes, we do see a rally. We get up to 40,000, but you can expect sometime Q2. You can expect another big drawdown. That will be because the recession will have kicked off by then. So I think the S&P most likely bottoms sometime in Q2. That's when the real pain is supposed to start from this recession. Right now, it's the going is good. We haven't had any negative GDP data. We haven't had anything that really signifies a recession. The labor market is strong. The labor market basically, and that's another tool that you could look at is in the U.S. is very strong, and usually that's an indication of a late cycle. Usually the labor market being this strong is it's a late cycle effect. So you can imagine that whenever the going gets bad, that you can expect that unemployment number to rise up, and this is the lowest it's been in 40 years. So if you were the Fed, most likely what you would do is you would stop hiking, yes, but it doesn't mean you would cut immediately. So I really do think Jay Powell is willing to hold the rates as high as they are right now for a couple, like a quarter or two more, and that could really drive in the pain. So as the liquidity dries up in the banking sector, you can expect that to have secondary knock-on effects in the overall liquidity that people get from banks. And so you could see banks not having as much loans that they make, and so that could really have a depressionary effect on the economy. And so as banks tighten up their credit because of the risks that come from having their books illiquid, you're going to see the recessionary effects of that. And so
all right, Michael. But looking at talking about the Fed, the U.S. Fed now, and expectation is they'll stop hiking rates going forward. But if that happens, what do you see happen with Bitcoin? Do you think that the price is going to keep going up, or if they stay hawkish, what happens?
Yeah. If they stay hawkish, I still think at some time they're going to break something. Something is eventually going to break harder than what we've seen, and most likely the thing that will fail right now is regional banks. We haven't had the commercial real estate shoe fall off yet. And what I mean by that is, I think over almost 10 to 20% of commercial real estate, in the namely offices, are vacant in the United States. And what happens when you have lower rents is you have to rewrite the basically the cost of your building. So, if you're bringing in less income, the way commercial units are valued is they're valued based on income. So if you bring in less income, you're going to have to rewrite the loan, and that means the institution who took up your loan is going to have to charge it, basically write down a loss. And so you're going to see a wave of rewrites that's going to cause another illiquidity on the books of these banks. And so once that kicks in, that's going to really be the next shoe to drop. And once that kicks, you're really going to see the recession really starting, because that's going to be the thing that might finally kill a regional banks. Because right now it's just they have government debt that basically it's illiquid and they can't easily sell it, and the government is backstopping that. But what happens when the books on hand that fails? I mean, the assets on hand that fails is real estate debt. The government is not easily going to just come back and back that up, because the government bond is like a 0% risk asset. They see it as the best asset to have on your book. Okay. So for real estate to fail, it's really going to have a knock-on effect on everything. All so right, my target for Bitcoin is somewhere close to 6 figures in 18 months. You're looking about 180,000. All right, I'm gonna
stamp that, Michael. And
Q4 2024. Early Q1 2025, you can expect, a 6-figure Bitcoin.
All right, so that's Michael's projection there. Thank you so much, Michael and Nigel. Watching out for that projection, a financial market analyst. Thank you.
Thank you, Lai.
All right, so that's how the market is looking today. So the top 5 gainers, the SNX top and the counter up 2.62%. So it's lean top gainers counter we're seeing today. Market not looking bad. Still early days in the second quarter of 2023, and we see BAT token there leading the losers counter down 8.88%. All right, that's it for the market today, and that's a wrap on the program. Don't forget to join us by 1:30 on Business Incorporated for more updates and developments in the world of business. Remember, you can watch this again on our YouTube channel. Just flip over to YouTube, search for Channel Television, and you can watch all our productions and videos. Thank you for watching. I'm Ladi Williams. Bye for now.